All right, class, welcome. Today, we're going to dive into a really practical, really important part of Canadian tax law, the moving expense deduction. Now, this is one of those topics that you are absolutely going to use, whether it's for your own move after you graduate or, more likely, for your future clients. Knowing these rules is essential, so grab your notes and let's get right into it.
Okay, with that out of the way, let's jump in.
Here's our roadmap for today. Think of it as our game plan. First, we're going to start with the basics, the why behind this whole thing. Then, we'll tackle the two big hurdles you have to clear to even be eligible. After that, we'll get into the nitty-gritty of what you can and can't claim, how to add it all up, and we'll finish off with some special rules that you'll definitely see in the real world. So, first things first, why does this deduction even exist? I mean, what's the big idea? Well, the government understands that for our economy to work, people need to be mobile. They need to be able to move for a better job, to start a business, or to go to school. This tax break is basically a little bit of help to ease that financial burden, to make it just a bit easier for Canadians to go where the opportunities are. Now, here's the absolute core concept, and I want you to highlight this. The deduction is claimed against income you earn at the new location. That's a critical detail we're going to come back to. Now, to make this all feel a bit less like a textbook, let's follow a case study. Everyone meet Maria. She's just graduated, she's moving for her very first professional job, and we're going to use her journey to see how these rules actually work in practice. Okay, so before you even think about pulling out a single receipt, you have to get past two major hurdles. I like to call them the gatekeepers of the moving expense deduction. If you fail either one of these tests, boom, the gate slams shut, you can't claim a single dollar. This is where a lot of people mess up, so let's really focus here.
And here they are, our eligibility gauntlet. First up, we've got the distance test, which is all about geography. And second, there's the income test, which, you guessed it, is all about the money. We're going to break them both down, starting with the distance test.
Now, this is super important, and it's a mistake I see students make all the time. The rule is not about how far your moving truck drove. You could move 1,000 kilometers, but if it doesn't shorten your daily commute by enough, you don't qualify. It's all about the reduction in that one-way trip to work. And the magic number you have to beat is 40 kilometers. Your new home has to be at least 40K closer. Let's apply this to Maria's situation. So her old commute would have been 60 kilometers. Her new commute is just 10 kilometers. The math is simple, right? We take 60, subtract 10, and we get a difference of 50 kilometers. So is 50 greater than 40? Yes, it is. So check. Maria easily passes the distance test. She's through the first gate. On to hurdle number 2, the income test. This one's pretty logical. You can only deduct your moving costs up to the amount of income you earned at that new job in that tax year. Now think about Maria. She's a new grad. Maybe she starts her job in October. Her income for that year might be less than her total moving costs. So what happens? Does she just lose out on the rest of that deduction? Nope. And this is a fantastic feature of the rule. You can carry forward the unused expenses to the next year. It's like banking that deduction to use later. This is an absolutely crucial rule for recent grads. All right, Maria made it. She passed both tests, so she's officially eligible. Now we get to the fun part. What can she actually claim? It's time to build our list, and knowing what's in and what's out is absolutely key.
Let's break this down. Look at the left column, the can claim list. This is the logical stuff, right? The cost of travel, hiring movers, temporary lodging for up to 15 days, even the legal fees for selling your old home. But now look at the right side. See the theme here? These are costs that happened before the move was a sure thing, like a house hunting trip, or they're costs to improve your new life, like decorating. Here's a perfect example of the distinction. You can deduct the realtor's commission to sell your old place, but you can't deduct the cost of painting it to make it sell faster. It's all about the direct costs of the physical move.
Now, let's talk about some deductions that are so often forgotten. These are the details that separate a good tax preparer from a great one. If your old home sits vacant after you move, you can actually claim up to $5,000 in maintenance costs, things like mortgage interest and property taxes. And don't forget all those little administrative fees. Utility hookups and disconnections, getting a new driver's license, they all add up and they are all eligible. Don't leave this money on the table.
So, we know what's eligible. The next question is, how do we turn those things into an actual number to put on the tax return? For some of the most common expenses, your car and your meals, the CRA gives you two options. You can use the detailed method, or you can use the simplified method.
Let's start with the simplified method, because honestly, it's the one most people use. It's designed for convenience. Instead of keeping every single gas receipt and restaurant bill from your trip, you just use a flat rate.
Now, you still have to track your kilometers driven for the move and the number of meals you had, but then it's just simple multiplication. For 2025, that's 60.5 cents per kilometer and a flat $23 per meal, up to 3 meals a day. Easy, right?
So let's go back to Maria. She used the simplified method for her 2-day drive. She logged her kilometers, counted her meals, did the math, and boom, her claim for just travel and food comes to $475.50. Now, that amount gets added to all her other eligible costs like the moving truck rental to build her total moving expense deduction. All right, we are in the home stretch now. We've covered the basics, the tests, and the calculations. Let's finish up with a few special rules that handle some of the more complex, real-world situations you're bound to run into. So, 3 key things to remember. First, that carry forward we talked about. It's your safety net. Second, for couples, if both partners move and both have income at the new location, you can actually split the deduction however you want between the two of you to get the best tax result. And third, the big one, employer reimbursements. The rule is simple. No double dipping. You can't get paid back by your boss and claim a tax deduction for the same expense. That's a big no-no.
But, and this is a very important but, what happens if the reimbursement only covers part of the cost? Let's say Maria's total moving bill was $3,000, and her new company gave her $1,000 moving allowance. Well, this quote right here is key. The CRA says she can claim the difference. So she would just reduce her total expenses by the amount of the allowance. In her case, she could still claim the $2,000 that she paid out of her own pocket. This is a hugely important nuance to remember.
So, to wrap this all up, here is your 4-step checklist for any moving expense problem. This is your process. Number 1, run the 2 tests, distance and income. Number 2, make your list, what's deductible and what's not. Number 3, pick your method, simplified or detailed. And number 4, look for wrinkles. Are there any special rules, like a reimbursement, that you need to account for? Follow these 4 steps, and you will nail these questions every time. And I'll leave you with this final thought to consider. We've spent our time today deep in the technical weeds, right? The how-to. But I want you to step back and think about the why. How does a tax policy like this actually influence the broader Canadian economy? By reducing some of the financial friction of relocating, does it encourage people to move for better jobs? Does it help fill skills gaps in different parts of the country? Does it make our entire labor market more dynamic and efficient? It's more than just a line on a tax form. It's an economic policy tool. Something to think about. That's all for today. Great work, everyone.